Welcome everyone to another episode of the Blue Sea Advisors Network Presents. And today we're honored to have with us an expert in the employee stock ownership plan arena. Her name is Mindi Johnson. She's a practicing attorney out of the Grand Rapids office of Foster Swift. I am very pleased to have her here to inform everyone about sometimes a little known or little considered strategy or an alternate strategy of how a business owner can transition his control of the business. It's not necessarily to an outsider firm like a strategic buyer or a private equity firm, but to his own employees. So I'm sure we'd all like to learn a little bit more about this, and keep in mind as we talk to our clients who might be considering an exit over the next few years, and offer this as a potential for them to consider. So Mindi, why don't you give us a brief introduction on your practice? Tell us a little bit about Steve Lowney, who I've spoken with before from your firm, and just a little bit of background about your experience in the ESOP arena and related arenas.
Sure. Well, thanks so much, Gary. I appreciate the invitation to come speak with you today. So I am an attorney with Foster Swift. I am co-leader of our business tax group, and I've been practicing employee benefits, ERISA, and ESOP law with this firm for about 10 years. I was with a smaller firm that focused on business and healthcare law in the Grand Rapids area before that. But when I came to Foster, I had the privilege of working with Steve Lowney, who at that point had about a 20-year ESOP practice that he had developed and really honed his skills. So it was really invaluable for me to step in there and learn from him. And then I've continued working with him since then. He's now on the road to retirement, so we don't see him nearly as often, but still work with his ESOP clients, kind of making a transition now to the next generation of ownership and next generation of management as well. So what I'd like to do is just give a general overview of what this ESOP strategy looks like from a very high level perspective. A lot of the stats that I've been coming across indicate that the next 10 years are really going to be critical for business succession. There are some stats that show about 2.5 million baby boomer business owners are going to be retiring in the next 10 years. So this is a good tool to kind of keep in your tool belt to just pull out as needed for the right type of client and consider it to be an option. So with that, I'm going to try to share my screen here, and we'll go to a presentation that I put together just to hit the high points of ESOPs as a succession strategy. So I wanted to begin by just highlighting and explaining what an ESOP is. And this acronym ESOP stands for an employee stock ownership plan. And that is a qualified defined contribution retirement plan and trust that's primarily invested in employer securities. So what that means is that this is a IRS tax qualified retirement benefit program, which is used to help employee participants plan for their retirement. But it's different from your typical profit sharing and 401k plan that's invested in mutual funds or stocks and bonds, because it's primarily invested in the employer stock of the company that the employee works for. So one of the benefits of that nuance is that the employee's hard work and effort in helping the business succeed is really going to increase the value of that company and correspondingly increase the value of their retirement benefits. The ESOP is a separate legal entity that also can serve as a potential purchaser of the company. So it is a separate 501A tax exempt entity, which has benefits particularly for an S corporation, and that if the ESOP is 100% owner of the company, there will be no corporate taxation. So in addition to finding a seller for the company that's a separate entity, the tax advantages of the ESOP strategy also weigh heavily on the decision to implement the strategy. When we are talking about the ESOP as a separate legal entity, it is distinct and set aside from the company. The company continues to serve as a plan sponsor of the ESOP plan, and also plan administrator. But there is a separate trustee that has a fiduciary obligation to manage and hold the assets of the company, which is the company stock, the stock certificates. And the trustee is tasked with holding those assets for the benefit of the employee participants who have a beneficial ownership in the company. And when we talk about implementing an ESOP strategy, I wanted to highlight who the premier candidate would be when we're considering various different companies. And I've highlighted the factors here that we consider to be kind of the best practice for a company that's considering an ESOP implementation. The first thing is that you need to have a shareholder that's committed to the good of the company. Generally, someone who has started the company from the ground up and really has a vested and emotional interest in continued success of the company. But they want to leave a legacy, and they trust their employees and want to do the right thing by keeping the jobs and company afloat and in the community. So you definitely have to have a shareholder that's committed to just the corporate identity and also the idea of leaving a legacy with a commitment and involvement of current employees. An ESOP company also has to be financially healthy, typically with a stable cash flow, increasing profits, and low debt. You also need to have a strong management team that share that same vision for the success of the company that the shareholder or founding owner of the company had. You do have to have a good solid number of employees. We generally see ESOPs starting to be considered at that 25 employee mark, but there are ESOPs with hundreds and even thousands of participants. So you can make it work if you have the right culture and at least a foundational number of employees. A company also considers ESOPs very often when there are no strategic buyer opportunities. So it might be a very closely held business in a unique industry that doesn't have a lot of interest from outside buyers. So the ESOP can present a solution to that situation where the shareholder wants to get out of the business. From an industry perspective, I pulled some statistics from the National Center of Employee Ownership, one of the professional organizations that's really focused on ESOPs. And based on their statistics from 2016, a couple of years ago, they've highlighted manufacturing as the #1 industry in which ESOPs are implemented. Following that are professional and technical service companies, finance, insurance, and real estate companies, and then construction companies as well. Those are always a good fit, just because of the makeup of the company and the sheer number of employees that are employed by those employers. I also took a look and just tried to get some round numbers to give you some perspectives on how many ESOPs are in Michigan. The Midwest, United States does boast the largest number of ESOPs in the country. And again, as of that 2016 statistic that was put out by the NCEO, there were just over 200 ESOPs in Michigan. And I don't doubt that that number has gone up since then. So we've talked a little bit about what the ESOP is in general and who's the best fit for it, but I also wanted to walk through how the ESOP strategy works. And I've identified a number of the steps here. I omitted the very first one about establishing the ESOP to begin with. So you do have to have a board of directors that has agreed to adopt the ESOP strategy and actually draft the plan documents, obtain an EIN for the trust, and get all the service providers lined up for it. But once that ESOP trust is in place, the selling shareholders sell their stock to the ESOP. The actual purchaser of that stock is going to be the trustee. So the trustee is going to hold the employer stock for the benefit of the employee participants. Relevant law, which is including the Internal Revenue Code and ERISA, require that the employer's stock must be valued by an independent appraiser with no conflict of interest. So the company cannot rely on its traditional business, financial professional, or even their business valuation firm that they've used in the past because of a potential conflict of interest. So you do have to have an appraiser that's retained to value the value of the stock. The ESOP pays for the employer stock that it purchases from the company with funds that it obtains either from the selling shareholders or the company itself. And I have an example of how that's done in the next slide. But once the selling shareholders receive the money for the stock that they sell to the ESOP, depending on the status of the corporation, if it's a C corporation, the selling shareholders have a real tax opportunity in which they may reinvest those proceeds in qualified replacement securities, which traditionally mean domestic stocks and bonds. And then they'll have the ability to take advantage of some significant tax benefits, namely the deferral of capital gains tax on the full proceeds from the sale. So they wouldn't pay capital gains at the time of the sale and may defer them until the qualified replacement securities are actually sold. Or if they still retain those securities at the time of the death, then the sales proceeds and capital gains associated with that receive a step up in basis. So it's definitely worth looking at if you have a C corporation and a selling shareholder who has the opportunity to sell to an ESOP because of the tax advantage there. When the shareholders sell the employer stock to the trust is the actual owner of the company, and the employees and participants are beneficial owners of stock. So sometimes when I give presentations to companies and their employees about implementing an ESOP, all of the employees think that they get to manage the company now because they're going to be part owners of the company. But that's not exactly true. They're not going to be deciding who gets a raise, who gets time off, because the management team continues to operate the company. And the participants are only beneficial owners of that stock. So the trustee is the one, the true owner of the stock, and acts on behalf of those participants. But when those participants do terminate employment, they will receive a distribution of those benefits. Typically what happens, primarily in an S corporation that's closely held business, there is a provision in the corporate bylaws that restrict ownership of the stock to a select few people. So you can't have hundreds of employees who can be shareholders. So there are relevant provisions in the Internal Revenue Code and ERISA that require those employees to put that stock back to the company. So when they retire, they get the cash equivalent of the value of stock that's held in their accounts. So that's how they generate the retirement assets and a real retirement benefit for the duration of their employment. So I wanted to circle back on how the transaction can be funded. Where does this money come from in order to buy out the selling shareholder? The first option is company contributions. If the company does have investments or a stable cash position, they can just purchase the stock from the selling shareholder and either loan that to the ESOP or contribute it to the ESOP for allocation to those participants. The second option is that shareholders may sell their employer stock to the ESOP on a promissory note. So effectively, they're financing that deal. Or a third option that can be attractive as well is for the company to obtain bank financing and then enter into a leveraged transaction with the ESOP. And I note here, and I'll explain in the next slide as well, that due to some special rules in the tax code, this strategy permits the company to effectively repay the bank loan with pre-tax dollars. So there are some tax savings by approaching that situation. And so I've scoped out and drawn out how this typically works with a leveraged transaction. We have a lender here on the top right-hand corner, which could be your corporate bank with which the company has an outstanding line of credit or some other bank that agrees to lend money to the company on a term loan. It could be 5, 10-year loan. Then the company in turn loans money to the ESOP. So it both gives the money from the bank loan to the ESOP and also requires the ESOP trustee to sign a note to the company. And that note generally is a longer term than the bank loan for the reason I'll explain in the next slide. But with the money that the ESOP trust obtains from the company, it gives that money to the shareholders who then give their shares of stock to the ESOP. So at that point, we have shares of stock in the ESOP trust that can be allocated to participants. And that's done through annual contributions that are made by the company to the ESOP, which I've outlined on this slide. So on the top right company here, the top right picture here of the company makes a tax deductible contribution on an annual basis to the ESOP. Because it's funding retirement benefits, it is eligible for a deduction. So with that contribution, the ESOP then automatically repays the company. So it's kind of a circular process where the company gives the money to the ESOP gives the money back to the company. By taking that approach, we're able to take advantage of that tax deduction, and the savings on the taxes typically allow the company to repay the lender on a more quick basis. So a lot of times that the term loan with the bank is prepaid in full long before the ESOP loan is prepaid. But one of the benefits of having an extended ESOP loan repayment is that only a portion of those proceeds that relate to the stock actually get allocated to the participants each year. So just because you have an employee that's hired and they may be eligible for a certain contribution of stock each year, they don't get the full contribution until the whole loan is repaid. So this does delay the acceleration of the stock in the accounts of participants for a period of time, which again helps motivate them to stay and contribute to the company. And then when they do ultimately retire or separate from the company, they'll receive a distribution of the shares of stock that are actually allocated to their account. So this slide highlights, in summary, some of the key benefits that an ESOP can present to different companies and different parties involved with a transaction. With regard to the selling shareholders, particularly those who would like to get out of the business and sell the company, it does provide a market for the sale of that company. It also does have certain tax advantages, primarily for selling shareholders who sell shares of C corporation stock to the ESOP based on the special tax treatment, which is provided under Code Section 1042. And it also allows the selling shareholders to leave a legacy, to leave this business that they've grown and honed and developed to the employees that have helped it thrive over the years. For the management team, there are benefits by way of continued and greater control of the business, but oftentimes also additional financial incentives that are provided to them in order to get them to stay and help continue this legacy that has been started by the selling shareholder. The employees definitely benefit from an ESOP because of the beneficial ownership of the company, where they see that their contributions made on a daily basis increase the value of the company and correspondingly increase the value of their retirement benefits. The employees also benefit from an ESOP because they get to keep their jobs. The business stays in place. Oftentimes when you do have a strategic buyer who is courting the company and ultimately acquires it, they'll remove the management team, they'll replace a number of employees, sometimes they'll even close up shop and set it up elsewhere. So with the ESOP, one of the huge advantages is the retention of those jobs in the community. And for the company as a whole, the benefits of the ESOP include an improved culture where you have employees who are engaged in the success of the company. They're going to want to see it benefit. They're going to want to see it become more profitable. So they'll work harder, and hopefully as a result, the value of the company will increase because of it. And there are also tax advantages to the company. The tax-free deduction I've mentioned related to contributions to the ESOP, the tax savings if it is an S corporation, primarily if it is 100% ESOP owned S corporation with no corporate tax, that can be a huge advantage as well. So that is my overview in a quick 15 or 20 minute summary. So I'm happy to open up with questions, and I will try to stop sharing of my screen now so I can do that.
Let me open it up for some questions now.
Mindi and Scott, if the company has a lot of employee turnover, how is that handled with employees that have shares in the ESOP?
Like a typical profit sharing or 401k plan, the ESOP can establish eligibility criteria for participating in the ESOP. So a lot of times we'll see plans implement a 12-month wait from start of employment or requirement of 1,000 hours of service. So they don't even become ESOP participants for at least a year since they've been there. So that generally covers a lot of those employees who have high turnover positions. But if they do come into the plan, there's also typically an eligibility requirement to receive a contribution. So once they get in, they again have to either work 1,000 hours or remain employed on the last day of that first plan year. And if they don't, they get no benefit. If they do, then we'll receive a contribution. But again, that contribution may be subject to a vesting schedule, like a profit sharing plan. So they might be 20% vested after 1 year, 40% after 2 years, and so on. So you can implement those eligibility features to, I don't want to say necessarily exclude those people, but at least limit the benefits in correlation to what they've actually contributed to the company.
Makes sense. Thank you.
Thank you. That was very informative. Do you see vesting schedules typically in the 5-year range, or do they go out longer than 5 years? By
law, they can't exceed 6 years. So I would say the most common is probably a 6-year graded. So 20% each year. So 20% after year 2, and then 20% additional up to 6 years of service.
So could you clarify that one aspect of your presentation when you said that the if the selling shareholder reinvests proceeds in domestic stocks and bonds, he can get a deferral of capital gains. How long is that deferral generally? I mean, unless he passes away, then it's a step up in basis. But how much of a deferral does he get?
He defers it until it's resold.
Ah, okay, very good. So it's not a specific time period, but until he sells the stock.
Correct.
So how soon does he have to invest those proceeds into domestic securities to qualify for that?
Within 1 year of the sale to the ESOP.
Anybody else have some questions? Mindi?
What would you say is some of the biggest pushback you get, or why people would say, oh, I don't want to do that, or they say it doesn't make sense?
There is a cost involved. So every year the ESOP has to obtain an appraisal from an independent appraiser. There are record keeping fees, depending on whether an outside trustee is retained versus someone within the company. There are fees associated with that. I think it also depends on the knowledge base within the company. So if they have a management team who not only gets on board with the ESOP, but appreciates the nuances and some of the technical requirements, that makes it a little bit easier. You have your standard reporting requirements like you would with a profit sharing plan, the Forms 5500, which have to be filed. There are fiduciary concerns with the ESOP too. So the trustee is going to be a fiduciary. The employer's plan administrator will be fiduciary. ESOP committee will be plan fiduciary. So they're tasked with making decisions in the best interest of plan participants. And if the plan participants disagree with the decisions that's made, they may be exposed to litigation. They may be sued and have personal liability for those decisions that are made. So that can allow people to get a little bit cold feet with some of those decisions and just making sure that it's something they really want to do.
And how does the company management go about selecting a trustee? Are there trustee firms that just do this? Or are they typical divisions of banks or CPA firms or consulting firms? Or who are these guys who do this?
So the first decision is whether they want to use an internal trustee within the company or hire someone on the outside. And if they choose to hire someone on the outside, I think there are a variety of different questions that should be asked. So the selection of a service provider is in itself a fiduciary decision. So when making that decision, the company really has to vet those trustees to make sure they're getting the best person at a reasonable expense, because that fee is generally paid from plan assets. So you would consider a variety of qualifications like experience, scope of practice within the ESOP area, fees, representative clients within the same industry, and you generally interview 2 or 3 different trustees to make sure it's a good fit with the company and you have a good working relationship. So when you've selected someone, you go through the engagement process, sign an agreement, and determine fees and whatnot. But there is a process that should be followed in order to satisfy those fiduciary requirements.
Do law firms offer trusteeship services like sometimes they do in estate planning, or typically would a law firm not offer any kind?
No, they would not.
Okay.
So I think in Michigan, I think only banks and specific trust companies can serve in the capacity of a trustee, or
Gotcha.
an individual within the company.
Right. Okay. Wow. Very interesting. Any other questions, guys? All right. Well, Mindy, that was very informative. Thank you. It's a great alternative to offer up to clients in the right case, and you've really helped surround us with some great criteria to keep in mind when we come across clients with that situation. So appreciate your time today and your generous sharing of information about it.